Good day to everyone, and welcome to this week's weekly market update provided by SC Securities Research. As always, we will be taking you over the major highlights for the stock market for the week, as well as delving into some of the more macroeconomic factors that have affected Sri Lanka. And then we will go over the secondary market, after which we will also touch upon the global commodity market and how it pertains to certain counters domestically, before we wrap up with the global market news. This week, we will be continuing our commodity watch, and Harin will be providing the technicals for gold this week, on top of the usual all-share technical analysis, and our pick of the week this week, Brown's Investments. So without further ado, let's actually head over to the stock market, and it was a very positive ending or a positive week for the stock market in recent memory. EXPO Strikes Back, that is the major headline that we go with, as EXPO again drives most of the market momentum up this week. Market actually did turn bullish, and we actually highlight the fact that it did turn bullish due to the fact that most of the speculation surrounding lockdown actually ended last Friday, after it was known that we were going in for a lockdown. So that actually ended most of the speculation that might have actually hindered the market last week, where we saw some topsy-turvy movements in the all share. So the ASPI actually rose by 5.33% this week, whilst the S&P rose by 6.27% this week. That is really, really significant. If we really look at it, the all share made monumental gains this week, with the bourse jumping by 239 points just on Monday. And the market actually having a turnover of 10.8 billion. This would not be the highest figure for turnover by any stretch of the imagination towards this week, and that is saying something. EXPO actually continued its momentum rise, as we did say earlier, by contributing 98 points of the total all-share gain on Monday. The firm decision, like we said, on lockdowns erased any speculation that might have plagued the momentum last week. The midweek saw the Colombo bourse actually continue its bullish run. However, there were some retractions as we witnessed some profit taking. However, still the market ended up in the green. So you can see that initially it was 239 and 188. So we saw on Wednesday a bit of a retraction, but it wasn't enough to stem or quell the bullish momentum. This week also, ever since midweek, it has been a great week for HAYL's, which saw the share price jump up by more than 4% midweek, and was the second most traded stock after EXPO. The week also saw the continuing battle of LOLC versus EXPO, as the tussle for the largest market capitalization continued, with just 129 million separating the two at one point during the week. Friday saw a slight slowdown with regards to gains, and this can be seen only up by 10.62%, and up by, whilst the S&P was only up by 18.17 points compared to the previous days. That is quite meager. However, if you look at the turnover figure, it was quite phenomenal, because it clocked up at 16.5 billion in terms of turnover. The only blight this week, and it seems to be the only thing consistent with the Sri Lankan stock market, is that the net foreign outflows for the week came in at 601 million. So pretty much all of this momentum is done by high net worth individual, a combination of high net worth individuals and institutional investors based locally. If we move on to the macroeconomic news, it is somewhat of a double whammy for the government or for the country, if you want to look at it. Basically, we saw the headline inflation figures for July come out, and headline inflation based on the National Consumer Price Index, or NCPI, has increased to 6.8% in July from 6.1% in June. The increase was primarily attributable to increases in both the food and non-food segments, with the rise in the food segment driven by sugar, rice, vegetable, among other key counters, whilst the non-food segment rise was attributable to transportation, which means it was linked to rises in fuel prices. The latest release confirms most of not just our assertions, but a lot of people's assertions, or expert assertions, that tally with the fact that this has been a rising trend since the start of the year. And despite the policy rate revision last week, this won't be enough to quell inflation. Furthermore, the central bank released data that pointed towards lower yields from worker remittances as proceeds came in at $453 million US, down 35% year on year for the period of July 2021 compared to July 2020. This follows on the back of proceeds from June totaling 478 million, whilst there was 460 million in terms of proceeds for May. The losses from April onwards can actually be attributed to a sharp disparity in the rates offered between the formal channels of banking and the grey market. So in the grey market, it actually goes for a higher price. So workers might actually be preferring the latter when it comes to the transfer of funds. The central bank also stated that the high level in worker remittances in 2020 was due to the increased stay period by migrant workers as a result of most international borders being shut. So that was for the previous year. In terms of the secondary market, we do go with the headline, break the ceiling or break the glass ceiling, as it were. Bond markets did remain largely frozen this week, with only 2 short maturities being quoted this week. We still maintain that because long tenure maturity bonds do not seem to have any traction, and that is basically on the back of what we've reiterated over the past few weeks, that the price ceilings must be lifted. The removal of these ceilings will actually help restore some government solvency in the domestic debt market, while it also gives some release to the forex shortages and allows the government to buy a portion of dollars required for external debt repayments. In terms of the commodity markets, we saw an increase in all commodity counters this week. Oil actually rallied this week despite a fall on Thursday, breaking a 3-day rally amid concerns of demand recovery as more COVID restrictions are being implemented globally. The gains this week can also be partially attributed to a fire on an offshore platform in Mexico, which knocked out a bit over 400,000 barrels per day in production. But the major headline is curb your supply, and that is pertaining to China's renewed output limits in certain regions that have driven aluminium prices to a 3-year high. So aluminium prices soared to their highest in more than 3 years as worries about supply from China escalated. As further limits were put on 5 smelters in the Xinjiang province. The limits actually represent a 10% output cut from levels seen in the first 7 months of this year. So that's quite significant. But what is even more significant is that Xinjiang represents a major smelting hub for the country and accounts for nearly 1/5 of the production from China alone. So any output limits in that region will see a huge knock-on effect in global aluminium prices. And this is something that will actually pertain to companies such as Alumex here, as they are one of the major aluminium producers for or manufacturers in the country, and this would represent a huge cost of production for them. So moving forward, and given that we do still expect aluminium prices to hit 3,000 tons per year next year, this might actually erode the profitability for Alumex moving forward in the next year. Copper prices also saw an uptick this week as many see China succeeding in curbing the spread of COVID. So indicators actually do suggest that the country's appetite for the metal is picking up quite rapidly. So that is actually a positive note to end our commodities watch. And in terms of the market watch, the global market awaits Poweels' exit strategy. So what do we mean by that? Asian stocks and European stocks all followed a similar trend where they ended mixed this week, towards the end of this week. And the mixed reaction is as a result of investors remaining cautious ahead of the Fed's annual Jackson Hole symposium. This is where the Fed chairman, Jerome Powell, is due to speak. And the symposium will mark Powell's address, where he will outline the Fed's exit from the accommodative measures it took to rescue the US economy from the pandemic. So we actually saw the Nikkei and the Hang Seng fall 0.36% and 0.18% respectively, whilst the Shanghai Composite was up by 0.6%. The European stocks also followed a very similar trend, with the Pan-European Stock 600 ending the session down 0.3% on Thursday. Those are the major highlights for this week. And continuing with our new trend, we will be doing a commodity watch. And this week, Harin will take you over gold. So I will give it to Harin. Over to you, Harin.
All right. Thank you so much, Nuwan. So looking at gold, what we can see is so looking at gold, basically we can see how the price has been declining over the past few days and how it came below the daily support level of 1740, 1760. And previously also we can see somewhat around in March, April, how there was a double bottom and how the neckline has been broken and the price reached to a level of 1900, and from 1900, that psychological area, we were able to see the price has been continuing to be declining and going further below the psychological area of 1700 once, and then coming back to the level of 1800. So currently what we can see is the price is actually in minor time frames, looking at 1 hour, 4 hour, we can actually see how the price is consolidating. So at the moment in the daily chart, the price is actually in the descending trend line, and they from thereafter, if the price actually breaks the psychological area of 1797, 1800, which I have drawn in yellow, which is actually considered as somewhat around a supply zone. So if the price manages to break that level, we'll be able to expect the daily resistance of 1840, 1860, if the price manages to break that key level. So RSI also looking at it, it's in the mid range, and so basically the price actually needs to break that trend decline in trend line in order to reach the daily resistance. Else, rejecting continuous rejection from this 1800 psychological area, the price could be falling back to the daily support level 1740, 1760. So looking at the all share index, so we were able to see the index closing, the RSI closed at 79.08, and it is quite in the overbought region at the moment. And also index closed at the daily resistance level 1900, 8900, 8950. So it also crossed the all-time high, which was 1925.82. So basically it was able to cross it today, and but however the index got rejected somewhat around making a high, getting to the near high of 9025.82, and was able to close at the daily resistance 8900, 8950. So looking at the moving averages also, we can see that there's a strong gap between the 18 and 18.8 moving averages and the index. So if the index, so in the upcoming weeks, if the index sustains below the daily resistance, it could come down to the daily support or even consolidate between the area of 8550, 8600, the daily support level, and the daily resistance level of 8900, 8950. So in the coming weeks also, if the index manages to break the daily resistance 8900, 8950 and close above the previous all-time high, we'll be able to expect it move into the daily resistance 9250, 9300. So looking with our pick of the week, which is Bill Brown's investments, we can clearly see in the daily chart the RSI is actually quite in the overbought region, which is 85.57, and also previous resistance, which was actually 820, and previous all-time high, which is 7.9, which was recorded in 12th January 2021. So looking at those key areas, and also the resistance level, previous resistance level 820, what we can clearly see is that today there was there was somewhat around a bullish momentum, and also heavily there was somewhat around volume, where the price continued to inclined to the daily resistance of 9.5, 9.6, breaking the weekly resistance 820, and also the weekly resistance 920. So the price was able to close at the daily resistance 950, 960, and making close of 9 and was able to close at 960 for the day. So for the upcoming week, if the price actually breaks the daily resistance and sustains above 960, we'll be able to expect 10-20 as the weekly resistance, that key level. If the price continues to decline from the 950, 960 region, we'll be able to expect the weekly support 920 again, or even break. If the price breaks the weekly support, we'll be able to expect the next daily support, which is 850, 860. So thank you. Over to you, Nuwan.
Thank you, Harin, as always, for your insights. And you can follow us on our social media platforms as shown below. We will be completely inundating you across all said platforms. And we will be sending this report across to our client base. But please do follow us on these social media channels. We do keep everyone inundated as best we can. So please do give us a follow, a like, and do subscribe. As always, we wish everyone a pleasant weekend. And as given the circumstances these days as well, we wish you all a safe and pleasant weekend. All right, thank you.